Okay, guys, next topic is variances. You already studied variances in F2, basic variances. If you forgot it, I've already made a video on it. Before looking at this video, watch that video. I will post link in the description of this video. The video is about basic variances, the concept, and I have done a question about the basic variances as well. So think of this video as a continuation of that video. So in F5 level, there is a little bit details in those variances. They go a little bit advanced. There are three main things that you study here. Obviously, the F2 level variances are assumed knowledge. You should know them. Anything that is in previous papers is assumed knowledge. So it is very important that you understand those to understand this chapter. So three main things that you are studying here is planning and operational variance, dividing all variances in two parts. And then you have material mix and yield variance, and then sales mix and quantity variance. So these three main things that are different. So let's look at planning and operational variance. So planning and operational variances can exist for all variances that you have studied. You studied material, labor, overheads, fixed overhead, sales variance. So it can exist for all of those variances. Now, variances, you already know, it is comparing actual performance with budget. So variance means difference. Now this variance could arise because of two reasons. One is that the performance is not good, means when people actually perform, the staff, the employees, they didn't perform well. Or another reason could be that the plan was not good. So obviously, if the plan was not accurate, it will not be achieved, or it can be both. So if plan is not good and there is a variance and we make the operational staff responsible, then it would not be good. They would be demotivated. Again, so we have to see whether the variance arises because there was problem in the plan was not realistic, or whether there was a problem in operation. So remember, whenever we are setting rewards or whenever we are setting standards, there should be controllability. So when we divide variances in two parts, an operational and planning part, we're looking at that controllability. So if we are looking at the performance of operational staff, they're only responsible for the operational part, which means where they didn't perform well. They're not responsible for the budget part. So this is the main reason we have this variance. So we have a question here. Remember, my style is I always work on question. And if there are any small detail points that are left in a lecture, I cover them in KIT questions, because in KIT questions, you're looking at different small things. But the purpose of lecture is to cover the important points. Okay, so requirement of the question is calculate the following variances for the month of November for both bed sheets and pillowcases and in total. We have material price planning variance, material price operational variance, material usage planning variance, material usage operational variance. So we have price and usage, but both of them divided into planning and operational. Assess the performance of production manager for the month of November. So looking at those variances, we have to see how the production manager performed. Okay, Bedco manufactures bed sheets and pillowcases, which it supplies to a major hotel chain. It uses just-in-time system and holds no inventory. Remember, just-in-time means production is only done when there is demand. The standard cost for cotton, which is used to make the bed sheets and pillowcases, is $5 per square meter. Both bed sheets and pillowcases use same material. Each bed sheet uses 2 square meters of cotton. Each pillowcase uses half square meter of cotton. Production levels for the bed sheets and pillowcases for November were as follows. We have bed sheets budgeted production and actual, and then pillowcases budgeted production and actual. The actual cost of the cotton in November was 5.8 per square meter. 248,000 square meter of cotton was used to make the bed sheets, and 95,000 square meter was used to make the pillowcases. The world commodity prices for cotton increased by 20% in the month of November. At the beginning of the month, the hotel chain made an unexpected request for an immediate design change to pillowcases. The new design required 10% more cotton than previously. It also resulted in production delays and therefore shortfall in production of 10,000 pillowcases in total that month. The production manager at Bedco is responsible for all buying and any production issues which occur, although he is not responsible for setting of standard costs. Okay, so first thing they've asked is find material price variance planning and material price operational. So what you basically do for all variances where you're finding operational and planning, you take the original budget, which was in original budget, and when you look at the actual performance, that will be total variances. Now we add something else in the middle, which is revised budget. If we look at the original budget and we look at the revised budget means the budget that should have been according to the information that we newly get. So because of the new information, we might believe that the budget should have been something different. So that is what is called revised budget. So if we look at the difference between these two, this will be planning variance. This simply means that the ones who are responsible in planning are responsible for this one. And then when we compare the revised budget with actual performance, it's called operational variance, which means those who were responsible for operational is responsible for these variances. Okay, so if we are looking at the price, the original price per square meter was $5. This is the original budget. But the actual cost of the cotton in November was 5.8. Now this is actual, I'll write it here. Now if I compare both, that would be total variance price. Okay, the world commodity prices for cotton increased by 20% in the month of November. So the person who made budgets, they didn't consider the increase in the price. When prices increase in the market, they should have been predicted by the people who are responsible for planning, because planning involves producing things for future, and they should have estimate of that. So if original price was $5, and if there is 20% increase, that means that the revised price should be $6. If we look at the plan and the actual, it seems like the people who bought didn't do well job because they bought it 80 cents expensive. But now when we look at the price in the market, it seems like they've actually bought it 20 cents cheaper. So the responsibility here relates to the people who did plan. Okay, so we have planning variance of $1 adverse, but the operational variance is actually 20 cents favorable. So multiply this by the kg that we purchase. Remember, we always take the kgs purchased. Whenever we are calculating price variance, we look at the kgs purchased or square meters purchased. They said here the actual cost of cotton in November was 5.8. 248,000 square meters of cotton was used to make the bed sheets and 95,000 pillowcases. So I believe this is what we bought. So 95,000. I'm combining both because they are same material. 248,000 and 95,000. So now when we multiply by the dollar, that will give us total variance of adverse. This is adverse planning. So material price planning variance is 3 for 3,000 adverse, which simply means that people who are responsible for planning did not estimate this. Now if we look at the operational variance, it is 68,000 favorable. So favorable operational. So that means if we hadn't divided variances like this, we would think of punishing the operational stuff. But now when we look at variances like this, they're more realistic. There is more controllability factor. Now it seems like we have to reward them for better performance. The overall variance total, they didn't ask, but it would be $5 minus 5.8. Let me write it here. And multiplying by the kgs. So if our variance reporting system was not right, we would have blamed operational staff for 274,400 adverse variances. But actually, 343,000 planning staff is responsible, and 68,600 operational staff has actually performed well. When I take these two and I add it together, it should give me 274,400. You don't have to do it like this if they don't ask you. It was just explaining the concept. So price planning and operational variance is done. Next, usage. Again, we look at the original budget and revised budget and actual performance. When we look at the original budget versus revised, that should give us planning, and then when we look at the revised versus planning, actual performance, that should give us operational variance. Okay, the original budget, remember, each bed sheet uses 2 square meters and pillowcase half square meter. Because the usage here is different, so I'm going to use it, do it separately for both of these products. I did it here as one thing because it was same material. We were only looking at the price. But now, because they're two different, even though the material is same, but the usage is different, so I will look at it separately. So we had 2 square meters and half square meters. This is the original. But revised, let's look at actual. So always look at the original and then look at the actual and write it. So we have 248,000 and 95,000. This is actual. 248,000, 95,000. Okay, obviously this is per unit, so I have to multiply by number of units, which is 120,000 and 180,000. 120,000 of bed sheets and 180,000 of pillowcases. But remember, they are just quantities. They have not yet been converted to. They have not yet been converted to value. If you look at the bed sheets, we have used 8,000 more, so it would seem like adverse. And here we have used 5,000 more. It would also seem like adverse. So the performance of the operational staff would not be fair. Remember, I looked at the actual production. Whenever you're looking at variances, you look at the actual production budget data. Maybe you're using it to find the fixed cost. Otherwise, whenever we are doing variances, we look at the actual production. If you look at the original production, then your variance analysis will give you massive variances. Okay, now when we look at the revised budget, okay, the world commodity prices changed, which was affected in the price. At the beginning of the month, the hotel chain made an unexpected request for immediate design change to the pillowcases. The new design required 10% more cotton than previously. It also resulted in production delays and therefore a shortfall in production of 10% pillowcases in total that month. So one thing is we changed the design, which consumes more, 10%, and this is relating to pillowcases, and this is why our production is 10,000 less. If you look at the bed sheets, it is the same, but if you look at pillowcases, it has decreased. Okay, revised budget for bed sheets should be same. There is no change. So I'm going to multiply by 100%, or you could just copy it. But pillowcases increased by 10%. The new design requires 10% more. Now if we see, we've actually consumed less in pillowcases and we've consumed more in bed sheets. Here 8,000 more, here about 4,000 less. Overall we have used more. So the operational staff is responsible. So I'm going to add it together. They are same material. So according to the original budget, we should have used 330 and actually we have used 343. If we look at both, it seems like 13,000 variance in terms of units. But when we look at the revised budget, it is only 4,000 variance. So we have 9,000 adverse planning because of the change in the design, which was not in the original plan. We have a variance of 9,000 adverse. And when we multiply that by the price, which price? This is where students make mistake. Remember, when we look at the price variance, we use different prices. We have used original price, we've used the revised price, we've used actual price. But when we look at usage, we are looking at the change in usage. So if we change price, then it will be two things. It will be looking at two things. So what we will do, we will keep the price same and the usage, the quantity will change. Here, if you see, we kept the quantity same, the price changed. So we looked at the change in price. So here we will keep the price same and the thing that changed is quantity. Which price will we use? We will use the original budget price. And we've already considered the change in price and pricing variance. If you look at the change in price here as well, then it will be looking at both of them collectively. Okay, so I'm going to use $5, which is the original budget. So always use the original budget. The reason is because we've already considered price in price variance. With 45,000 adverse, $20,000 adverse. So this is adverse planning, and this is adverse operational. If we hadn't looked at variances like this, if we had looked at it as overall, then there would have been 13,000 adverse, which multiplied by the $5 would have been $65,000 adverse. So we would blame operational staff for 65,000 adverse variance, which would not be fair. Now, dividing variances like this makes it more fair. Remember, our performance management, specifically measurement, should have that controllability part. Then the targets would be realistic and people will be motivated. Okay, so you don't have to do this part. They only asked about this one, this one, this one, and this one. Okay, so here we just had to calculate the variances. And next one, they said assess the performance of production manager for the month of November. We have to see what the production manager is responsible for. So usually it would be relating to production. He would not be responsible for buying and stuff, yeah? But look at the scenario specifically to see what his responsibilities are. Otherwise, you have to assume, you have to know what a certain manager usually does. Okay, production manager at Bitco is responsible for all buying. So here, he's responsible for buying as well, and any production issues which occur. Although he's not responsible for setting of standards. So that means he's not responsible for this one, he's not responsible for this one. He is responsible for buying, which means he has saved money here, and then here in the usage he has used more cost. Okay, I've commented on it here. The total material variance is 3394 adverse. Production manager doesn't seem to be responsible for this. If you look at it, we have 274,000 and 65,000 becomes 339,400 total material variance. So a production manager doesn't seem to be fully responsible for it. He is responsible, but not fully. Let's look at each of them separately. And always try to look at your marks that are given and then try to divide those marks in the comments. So it is easier for the examiner to mark them. And it would be easier for you to mark it as well. So there are four of them, so I would assume there would be 2 marks commenting on each of them. Okay, material price planning variance is 343,000 adverse. The production manager is not responsible for this. So you say he's responsible, he's not responsible, it is not enough comment. You have to say why. As he's not involved in the standard setting. The variance arises because the plan was not correct, as the 20% increase in the market price was not estimated in the budget. And the material price operational variance, 68,600 is favorable. Production manager is responsible for this as he's involved in day-to-day operation and purchases. Normally this would not be responsibility of production manager, but purchasing manager. This variance arises because the actual purchase was done cheaper. Production manager should be rewarded for this because the performance is good. And then we have usage, planning, why have I written 120,000 here? Material usage planning is 45,000 adverse, that's right here. Production manager is not responsible for this as he's not involved in standard setting. This variance arises because the plan was not correct as the 10% more usage in the design was not estimated. Did I write here 10%? Yeah, that's right. This variance arises because the plan was not correct, as 10% more usage and change in design was not estimated. And the material usage operational variance is 20,000 adverse. The production manager is not responsible for this, as he's involved in day-to-day operation. So conclusion, overall the production manager has saved 68,000. Where was it? 68,600 and minus this adverse variance. Remember, whenever you are commenting on a question, if your comments are right according to your calculation, even though if your calculations are wrong, maybe you didn't focus on a number, you put a wrong figure, it happens in exam. If your comments are relevant to what you answered, you will get marks for the comments. So your comments would be considered right. Okay, so this is planning an operational variance. So simply, it can happen in any variances that you studied. So you have to simply look at, you simply add another thing that is a revised budget. And also remember, focus that you have to use the original price here. So price doesn't change when you're looking at usage. And usage doesn't change when you look at price. Okay. Okay, next is mix and yield. It only happens in material variance. There is no mix and yield for labor. It is only for material. You studied in F2 material variances. One was the total variance, and then there was divided it into price and usage. The usage can be further divided into more parts. The mix and yield. So usage variance was the overall usage of material. If we had used more material, it was adverse. If we had used less material, it was favorable. Now, mix and yield happens in a situation where a product uses 2 or more materials. We want to know the mix. So if we talk about mix variance looks at the mixture of material. We want to see whether the mixture of material that we used is expensive or cheaper. If there are 3 materials, one of them is expensive and then one of them is cheaper. If we use more of the expensive material, our mix would be adverse. That mix would cost expensive. In food, for example, if you're cooking something and you put it is made of different ingredients, and you put an ingredient that is expensive and you put more of that ingredient, that food would cost you more. And if the ingredient that is cheaper, if you put more of that ingredient, then the food would cost you less. So this is basically mix variance. So we want to see whether the mix that we have used, according to the standard, whether it is cheaper or whether it is expensive. And then yield is the return. So we want to see what is the overall output that we have achieved. So mix focuses on the input and yield focuses on the output. Sometimes, even though we have used expensive material, which means mix is expensive, but the overall output that we have achieved has increased. So the return has increased. That is called yield variance. When we combine both of them, that will give us volume variance. So let's look at a question on it to better understand it. Briefly, okay, we have the top as well. Calculate total material mix variance and total material yield variance for September. Briefly explain what the adverse material mix and favorable material yield variance indicate about the production at Safe Soap Co. in October. You're not required to discuss revision of standards or operational and planning variance. Discuss whether sales manager could be justified in claiming that the change in material mix has caused an adverse sales volume variance in October. Okay, reading from the top. Safe Soap Co. makes environmentally friendly soap using 3 basic ingredients. The standard cost card for one batch of soap for month of September was as follows. We have material lye, coconut oil, shea butter, and then kilograms of each that are used. So there should be this standard mix. We have 10 kilograms, we have 4 per kilogram, we have $3 per kilogram. So remember, if we use more of the first material, then our mix variance would be adverse. If we use more of the third material, our mix variance would be favorable. The budget for production and sales in September was 120,000 batches. Actual production and sales were 136,000 batches. The actual ingredients used were as follows. We have material 34,080, 83,232, and 64,200. So let's look at first thing first. Calculate the material mix and material yield variance. So this is the actual performance that is given. So what I do is I make a format and I start from bottom up. For me, it is easier to work from bottom to top. So I take the actual result, which is 34,080 kilograms, 34,080, 83,232, and 64,200. So this is the actual that we have used. I'm going to write it here. So this is something called actual quantity, actual mix. You might see it, you might see the term used in exam. So this is the actual quantity, actual mix. The actual quantity according to the actual mix that we have used. If I total it, it becomes 181,512. Now this is without multiplying by the price. If you saw the price was 10, 5, and 3. Remember, even if the price changed, we use the original price. Remember, I explained when we look at the usage and mix and yield relates to usage, we look at only the change in quantity. Okay. Now this material that we used, the actual material, what if we had used them in standard quantities? How much each of these materials we would have used? Like the standard quantities of material, if we see we have 0.25, 0.60, 0.50. So we have 1.35 total. So if I take this total material, multiply by the usage of the first one, which is 0.25, divide by 1.35, which is the total. So according to the standard mix, the actual quantity, the quantity is actual. But according to the standard mix, I would have used this one, 33,613. Let's do the same for all others. Multiply by 0.60, divide by 1.35. And then 0.50. see if I had used, see the total here and here is the same. The only thing that changed here is the proportions of each material. So if I had used the materials according to the standard quantities, I would have used this material less. But actually I've used more, so that means the mix variance is adverse. Why? Because I have used more of the expensive material. I should have used less. The material that is cheaper, I should have used more, but I have used less. So that means my mix variance would be adverse. So multiplying by the price, total we have, if we had used the material according to standard mix, that mix would cost 941,000, but now the mix costs 949,000. So we have adverse variance. So remember, conceptually, expensive material is used more, so it should be adverse. So we have adverse material mix. Okay, so taking the same quantity and looking at according to the standard mix, we'll look at the mix variance. And focus here, the quantity remains the same, the mix changes. We are looking at actual mix with standard mix. Next thing I put at the top is standard quantity, standard mix. So first, there was actual quantity and actual mix. Then the quantity was actual, but standard became, the mix became standard. Now the quantity is also standard, the mix is also standard. Which simply means that the quantity that we produced, the actual production, 136,000. The standard quantity and standard mix should be how much? Just multiplying by the standard usage, which is 0.25, 136,000.60, 136,000.50. .60, 0.50. So if we look at the standard quantity, standard mix, we have this here 34,000. But when we look at actual quantity and standard mix, we have 33,000. What it simply means is that if we had used the quantity according to the standard mix and the standard quantity, we would have used 34,000 of L, 81,000 of C, and 68,000 of S. When multiplied by the price, we have 952,000. And when we compare that with the actual quantity standard mix, we have 941,000, so we have favorable material yield. So even though the mix is expensive, we use more expensive material and less cheaper material, but the overall output that we have achieved with those is more than we would have achieved with standard. And remember here, the mix is standard in both of them, but the quantity has changed. Okay, so here quantity was same, we look at the change in mix, and here mix is same, we look at the change in quantity. So my recommendation, start from the bottom and then look at the same quantity according to the standard mix, and then just take the actual production, multiply by standard usage. That should give you your answer. If we look at overall, we add both of them together, we have 2,440 favorable material usage. They haven't asked about that, but if you calculate it, it should be something like this. If I do it, see, when we are calculating usage variance, we look at the actual usage that we have done according to the standard price, and the standard usage that we should have used according to standard price. And when we compare both, that should give us variance. Because actual is less, we have favorable variance of 2440. So what we have basically done is added this something, actual quantity standard mix, to find the mix variance and yield variance. Okay, let's focus on the next requirement. Okay, in October, the material mix and yield variance were as follows. They said, let's ignore the top and assume that the mix was 6,000 adverse and yield was 10,000 favorable. The production manager is pleased with this result, overall stating, at the beginning of the September, I made some changes to the mix of ingredients used for the soap. As I expected, the mix variance is adverse in both months because we haven't yet updated our standard cost card in both months. The favorable yield variance more than make up for this. Overall, I think we can be satisfied that the changes made to the product mix are producing good results. And now we are able to produce more batches and meet the growing demand for our product. So this is the view of the production manager. The sales manager, however, holds a different view and says, I'm not happy with the change in the ingredient mix. I've had to explain to the board why the sales volume variance for October was 22,000 adverse. I've tried to explain that the quantity of soap has declined slightly and some of my customers have realized this and simply aren't happy, but no one seems to be listening. Some customers are even demanding that the price of the soap be reduced and threatening to go elsewhere if the problem isn't sorted out. Briefly explain what the adverse material mix and favorable material yield variance indicate about production at Safe Soap Co. So what it simply means, discuss what each of these variances means, and then explain whether whatever the sales manager is saying could be right or no. Okay, the first one I've already explained here. The material usage variance can be further divided into mix and yield. I've explained here there should be, remember there should be three conditions for material yield to exist. One, product should use two or more materials, and these materials can be substituted for each other, so you could use one material more and another material less, and they should be used in a standard mix. And then I've explained these. I've already explained that. And then, because they ask about the company specific, and then I've explained that what the 6,000 means and what this 10,000 means. The 6,000 adverse, it means that the mix was expensive, more expensive material used, and less inexpensive material is used. And yield 10,000 favorable means that output achieved from the input is more than we would have achieved had we followed the standard. And then in the second one, we have to explain whether the sales manager is right in his claim or not. Okay, effect of demand Effect on demand. Of change in mix. Change in mix could favorably or adversely affect the sales demand, because if the mix changes, the quality of the product would change. Now the new quality is either liked or disliked by the customer. It depends. Maybe they like it, maybe they don't. If they like it, it could increase the demand, or if they don't like it, it could decrease the demand. But customer would take some time to realize that. So it would take some time for customer to realize that and affect the demand. So sometimes what happens is, like the sales manager was not able to achieve the output, the sales demand, so maybe he has found a reason to blame. And he's saying that the demand has decreased because there is a change in quantity. Without evidence, it would not be justified. But because there is already complaints received from the customers, we could say that his claim could be justified whenever there is change in quality, it could affect the demand. So this is mix and yield variance. Next we have sales mix and quantity variance, which is basically the same thing. Okay, this mix and yield variance exists for sales as well. It only exists for material and exists for sales. But in sales, it is not called mix and yield. It is called mix and quantity variance. When we look at the sales volume variance, we divide it in two parts. One part is called mix variance, another part is called yield variance. So there are conditions, obviously, for the products, for sales mix and yield variance to quantity variance to exist. One condition is the company should be selling two or more products. If the company is selling only one product, there wouldn't be any mix and yield variance. And they should be sold in a standard mix. Remember when we calculated break-even point for multiple products, we had a condition that there should be a standard mix. The same condition should be here. So remember, sales volume variance is selling more or less than the standard, the budgeted sales. Now if we take those and divide it in two parts, one would be called mix and another would be called quantity. Mix variance is just like material. In mix variance, we want to see the product that we have sold, the overall product that we have sold, whether we sold more of the expensive more profit-making product or less profit-making products. If we sell more of the more profit-making products, then our mix would be favorable. If we sell more of the less profit-making products, then our mix would be adverse. Like in this example here, with chocolate crunch and strawberry sundae, it has 5 profit per unit and we have 3 profit per unit. So if we sell more chocolate crunch, then mix would be favorable. If we sell more of the strawberry sundae, our mix variance would be adverse. And then when we look at the overall quantity that we have sold, that would be quantity variance. Okay, let's look at the question. Just Desert Limited makes and sells 2 products, chocolate crunch and strawberry sundae. The budgeted sales and profit are as follows. Chocolate crunch 400 and 300, so this is the standard margin. We have revenue, cost, profit, and profit per unit. Actual sales were 280 units of chocolate crunch and 630 units of strawberry sundae. The company management is able to control the relative sales of each product through the allocation of sales effort, advertising, and sales and promotion. So it means we can boost the demand for each of these products, depends on our advertisement. So what I like to do here is just the same I did for material mix and yield variance. I look at the actual sales, which is 280 and 630. Total sales overall is a 910. What if I had sold them in standard mix? If I had sold them in standard mix, I would have sold 400 of chocolate crunch. Remember, if I add both of them together, they become 700. You could multiply by 4, divide by 7, or you could multiply by 400, divide by 700. Both of them will give you the same result. I would have sold 520 chocolate crunch and 390 strawberry sundae. Remember, the overall quantity should be same, only the mix changes. So you can see, according to the standard mix, the profit making should have been more. And here the more profit making is less. So that means mix is adverse. So we had $5 profit here, we had $3 profit here. $5 profit here and $3 profit here. Remember, if we are using marginal costing, then we would multiply by contribution. But here profit is given, I will just use that. So 5 and 3. So before you calculate the answer, you should know where your answer should be. So I already know it should be adverse. So if I had sold the product in standard mix, I would have made 480 more. So we have adverse sales mix variance. Now if we look at, sorry, this is something else. Now if I look at the standard quantity set, standard mix, which was in the budget, we had 400 quantities and 300 quantities, overall 700. So you could see we have more quantities, so quantity should be favorable. Even though the mixture changed, because of which the less profit making units are more profit making units are less, but the overall quantity that we have achieved is more. So we have $870 favorable sales quantity variance. Okay, so even though our mix variance is adverse, but the overall quantity that we have achieved because of the change in mix is justified more. If you look at it, it is justified more. It is more than the adverse that we have in mix. And when we look at it overall as total, when we calculate the normal volume variance, we look at the actual quantity, multiply by the standard profit, and we look at the budget quantity, multiply by the standard profit, and compare one with the other. You can clearly see actual is more 390 favorable. And when we look at these, it is sales volume. So it is basically putting something extra which helps explain the variances in more details. So this is it for advanced variances. So anything small points will be explained in KIT questions. So I spend a lot of time on KIT questions. Okay, so this is it.